Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past, but also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty Index was up 3.9% for the month ended July 2024. The Nifty Midcap 150 Index as well as the Nifty Smallcap 250 Index was up by 4.9% in July 2024. The India VIX saw a decline in July 2024. It was at 13.25 compared to 13.80 in the previous month, down by 4%. The Chicago Board Options Exchange VIX saw an increase in the month of July 2024 and was at 16.36 as against 12.44 on the previous month, up by 31.5%. Sector-wise, Nifty IT plus 13.0%, Nifty Pharma plus 10.4%, and Nifty FMCG plus 9.4% were the top-performing indices, whereas Nifty Metals minus 2.4%, Nifty Bank minus 1.5%, and Nifty PVT Bank minus 1.4% were the laggards. Global indices ended the month of July 2024 on a mixed note. Dow Jones was up 4.4%, Nasdaq was down by minus 0.8%, while FTSE 100 was up by 2.5%. Foreign institutional investor, FII, were net buyers for the month of July 2024. Net FII inflows were INR 27,958 crores. Domestic institutional investor, DII, bought stocks worth INR 23,486 crores, whereas MFs were net buyers worth INR 20,601 crores. Nifty forward PE is now trading greater than one standard deviation over the mean PE. However, it is still 5.8% below its peak. Nifty Midcap 100 is trading greater than 2 standard deviation above the mean forward PE. Over the years, the impact of foreign institutional investors on Indian markets have reduced. In 2022, foreign institutional investors sold rupees 1,21,439 crores, but domestic institutional investors neutralized them with purchases of rupees 2,75,726 crores. Similar scenario persists in 2024. What's more interesting is that individuals have been net buyers since 2020 each year, a huge change from the previous period of the decade. The drawdowns have been so limited as domestic institutional investors and individuals competed to buy into any fall in markets with intermittent interest from foreign institutional investors. SIP flows continue to post new records. The quarterly results-related stock volatility has been on the higher side. Even lackluster performance has been ignored. The dips have been bought into as every correction has been used a buying opportunity despite elevated valuations. As per our experience, days having sharp market drawdowns have attracted higher inflows versus normal. This is perhaps indicative of increasing retail investor maturity, confidence in the India story and the opportunities that the economy offers has helped keep investor interest high. Although the verdict is yet to be out on the complete Q1 financial year 2025 results season, the numbers reported till now across sectors have been mixed. Election and the heat wave have been primary hurdles faced by the consumption and construction sectors. Exporters continued to be challenged by uncertain demand conditions in global markets. Although commodity consumers benefited by lower input costs, slow demand spoilt the show in most cases. Commentary, however, does suggest brighter outlook as we step into the H2 CY24. Market regulator SEBI, acknowledging speculative hyperactivity in derivative markets, particularly by individual players, and has floated a consultation paper with an objective to strengthen the derivatives framework for enhancing investor protection and ensuring market stability. It has proposed tighter derivatives regulations to boost market stability and protect small investors. We will have to see the impact on the volumes as and when some of these steps are operationalized. There were high expectations leading up to the budget that the government would take measures to boost consumption and growth, especially in context electoral results, as well as persistently slow rural consumption. However, the budget was short on any relief, and versus the interim budget there were no major surprises. The government continued with its focus on spending in core infrastructure areas, while expenditure on certain social welfare schemes was under control. The budget did minor changes to tax rates for individuals, while capital gains taxes were rationalized across asset classes. Following were the key highlights of Union Budget 2024. On fiscal discipline, government stays the course on fiscal consolidation path. Fiscal deficit reduced to 4.9% in FY25 from 5.1% in the interim budget. On taxation, capital gains tax revised up for both the short term to 20% and long term to 12.5% for certain assets. This turned out to be a negative surprise, with withdrawal of indexation benefits particularly hurting the property sector. On the personal tax front, standard deduction for salaried employees was increased and the tax rate structure under the new tax regime was also revised. All in all, it would be reasonable to assume that the government is gradually nudging the taxpayers towards a simplified personal taxation regime in future. On CapEx, the capital expenditure story has specifically played out well in the last 5 years, as the government took active steps to improve the quality of spending. 5 segments: telecommunications, defense, transfer to states, railways, and road transport and highways account for about 86% of the total capital expenditure allocation in FY25. Defense spending was up 9% year-on-year, and allocation to roads and railways remained anemic. PSE capex growth has been the big surprise versus the interim budget, 15% versus 5%. On revenue spends, although government has been aiming to increase allocation to capital expenditure, revenue expenditure still accounts about 77% of the total government expenditure and is expected to grow further by 6.2% in FY25, compared to 1.2% in FY24 PA. Increase in revenue expenditure at the expense of capital expenditure may lead to worries if the government capex has peaked for the near term. Markets seem to remain volatile in face of mixed results. Markets have been euphoric on growth expectations on infrastructure and capital goods, with valuations leaving little room for error. We are seeing increased volatility in stocks where results have been below expectations. Although there were no sharp drawdowns in any sectors, we saw sectoral rotation ensuring higher returns in defensive sectors such as tech, healthcare, energy, and staples. Had the budget taken steps to boost consumption, we could have seen a further play in consumption stocks where, particularly in staples, the demand has been in hibernation for a while now. Even in IT, demand recovery hopes aside, execution has been very weak and growth anemic. However, now, this hope trade may peter out and incremental recovery in demand may need to be visible to support the valuations here. Financials, where valuations are attractive, continue to be laggards as they bore the brunt of regulatory pressures as well as worsening credit quality on the unsecured loans portfolio. Discretionary consumption is bottoming out. We have seen discretionary consumption businesses suffer over the last 2 years with profit as well as valuation destruction. We are focusing on pockets of consumption where we think that the worst is behind and growth momentum should pick up. Tactical allocation to defensives. Healthcare continues to be on our favored list. On IT and banking, we remain tactical in our approach. CapEx cycle strengthening. We are seeing CapEx on the ground with government, PSU, and now even private companies announcing new aggressive plans. We may continue to look for opportunities in capital goods space. We remain optimistic on the mid-caps and small-cap space due to much higher growth as compared to large companies. We have seen new businesses list across varied sectors. However, we are being cautious in terms of availability of visible cash flows and reasonable valuations in the names that we assess. Global conundrum. The interest rate hikes in Japan and JPY appreciation can likely lead to the unwinding of the yen carry trade. Also, weakening data points on the US economy has led to recessionary fears. In this scenario, commodities can head lower, which is favorable for margins. Also, still elevated container freight rates along with global macro weakness may prolong the exports revival. We are adding weights to domestic consumption themes to benefit from lower inflation and booking profits in companies more exposed on the export side. Market valuations are continuing to be high, but vibrancy of the market is leading to several turnaround, deleveraging as well as consolidation opportunities. We are very optimistic about the prospects of growth in the Indian economy. We continue to be disciplined about valuations and are approaching the markets with high diversification in our portfolio. Although we continue to operate with high conviction in our top-down sectoral, market cap positioning as well bottom-up stock picks, we may remain vigilant and flexible to adapt to market conditions if they change. Higher volatility and faster sectoral rotation is expected in the remainder of 2024.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.